This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I'm a trend-following guy. That means the stories, the narratives, all of the bullshit that runs 24/7, whether that bullshit comes from the mouth of just some guy, or perhaps it comes from one of the richest people in the world running one of the most successful hedge funds in the world. Does that mean I'm sitting here telling you that I think Ray Dalio is spewing bullshit? Not exactly. But today I want to pick apart some comments from Ray Dalio. As I just mentioned, one of the most successful fund managers of all time, if not the most successful. Now, Ray doesn't give a lot of information out about his firm. There's a very interesting document you can read online that talks about his corporate culture. I do know that he has said he is 100% systematic in his trading system. However, he has also said that he does not use technical information and only uses fundamentals. That's always a great foundation to keep in mind for any analysis of Ray Dalio and his firm. 100% systematic, which ultimately means all the opinions, and I say this with all due respect, all the opinions do not mean squat. My opinion doesn't mean squat. Because if you're 100% systematic, you are 100% systematic. That means you're going to do what your system says to do, not what some stock jockey sitting at a terminal happens to feel at that moment. This is automation, people. This is how it's done at the highest levels. It's how you should do it too. I mean, everyone should be automated. Whether that automation is a simple system that you stick to and you follow the rules religiously, the automation is in a spreadsheet, the automation is in TradeStation. I really don't care. Automation can be done in so many different ways. But you just have to stick to the damn rules. That we know works. All that said, I want to pick apart, I want to read some excerpts from Ray Dalio over the last couple of years, because we've all seen in the press this fear of what will happen when the Fed raises rates. When the Fed raises rates from freaking zero or possibly negative soon, when the Fed raises rates a quarter point, the world will end. If we ever had 1 or 2% interest rates again, the world would end. Maybe the world has already ended financially if there's that much fear that if rates ever went back to 1 to 2%, that we would have major problems. Think about that for a moment. Let me get into this article. This is from March 17th, 2015. Hedge funder Dalio thinks the Fed can repeat 1937 all over again. Reading from Bloomberg, Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, told investors there's a risk that the Federal Reserve could create a market rout similar to that of 1937 if it raises interest rates too fast. Too fast. What the hell's the definition of too fast? Let me continue. The Fed has signaled that rates will rise in June or September. Now, this is for 2015, and it would be difficult for policymakers not to deliver. Not so difficult, they didn't deliver. Continuing with the article, Dalio and Mark Dinner wrote in a note to clients dated March 11th, given Bridgewater's belief that the same things happen over and over again. The $165 billion Westport, Connecticut-based firm doesn't want to have concentrated bets, according to the note, a copy of which was obtained by Bloomberg News. They don't want to have concentrated bets. They are 100% systematic. They're going to have whatever bets their system says to have. They're not making their bets up on the fly based on what they think the Fed is going to do. They are making their bets in a systematic fashion. The article continues, quote, "We don't know, nor does the Fed know exactly how much tightening will knock over the apple cart," end quote, Dalio and Dinner wrote. Quote, "We think it would be best for the Fed to err on the side of being later and more delicate than normal," end quote. Whose head is spinning besides mine? More delicate than normal. What the hell is normal about everything that has taken place since March of 2009? There's nothing normal about it. And what the hell does delicate mean? Yeah, I'm actually sitting here and I'm throwing pot shots at one of the richest guys in the world. Because, yes, he's a smart guy, but this kind of stuff, I'm not really sure what the purpose is. Why does Ray Dalio even need to talk to the press? What purpose does that serve him? I can only assume because he has investors, perhaps nervous investors, from public pension funds, other state-run agencies that have massive investments with him, and they don't understand their ass from a hole in the ground. So if I'm Ray Dalio, I have to go out and talk to the press to reassure and to give people comfort. That's the only thing I can think. I don't know what other reason does Ray Dalio have to talk to anybody? He should just run his system, be quiet, keep it mysterious. Because when you start talking, it forces people like me to ask a few questions. Yes, I'm just another guy out there, but damn it, I can observe these words and I can say, what the hell does this mean? Again, delicate? Can somebody quantify the word delicate? How much tightening will knock over the apple cart, he says. The apple cart? What is the apple cart? What does how much tightening mean? We are at 0 interest rates. 1% is knocking over the apple cart? I mean, nobody gets interest income anymore, and we're sitting here supposedly afraid that if you raise rates to 1% or 2%, God help us, 3%, that the economy implodes. Are you kidding me? One can make the argument that if we are talking that way, it has already imploded, and we are zombies walking around a wasteland of fake economy already. Yes, I get a little excited here occasionally. The article continues. Dalio joins Jeff Gundlach in warning that the Fed runs the risk of having to reverse course if it raises interest rates too aggressively. Gundlach, the co-founder of Double Line Capital, this month called the Fed a blockhead for not learning from errors made by global counterparts, which raised rates too soon and then had to cut them. Continuing in the article, Bridgewater in the note drew comparisons between recent years and those leading up to 1937. In both periods, interest rates had fallen to 0, stimulative monetary policy fueled a rally in asset prices, and the U.S. economy rebounded, according to the note. When the Fed started to tighten monetary policy in several steps, bonds sold off and the stock market slumped by more than 50% from a peak in 1937 through March of 1938, prompting the Fed to reverse course, Bridgewater wrote. This is absolutely nuts. Stock market's correct. We can't stop corrections. It happens. Human nature is such. Greed pushes things way, way up. Fear pushes things way, way down. Unless Daniel Kahneman's work has been proven to be wrong, we're still humans. There's still bubbles. There's still bust. There's still going to be 50% drawdowns in stocks, and you can't stop it. So please, Ray, why are we talking about whether or not we can stop a stock market correction? We can't. There's going to be 50% down periods. Look, as different as Warren Buffett is compared to trend following trading, Warren Buffett has taken multiple 50% hits in his investing strategy at Berkshire. That's the normal course of events. If you're not willing to take that, if there is no downside, if there is no volatility, all we're setting ourselves up for is the mother of all meltdowns. I saw this great tweet the other day from Nassim Taleb. My co-author and I have data showing that hedge funds who blew up in 2007 to 2008 were those with the lowest daily volatility, highest Sharpe ratio, meaning the safest of the safe are actually not so freaking safe. They're the ones that blow up. Now, that tweet I just read from Nassim Taleb was just from the other day. The article that I read was from 2015, over a year ago, with Ray Dalio's views. This fear thing about the Fed raising interest rates, guess what? It hasn't changed. It hasn't gone away. Now, roll forward over a year into April 2016. I'm going to read some interview excerpts from Ray Dalio with Marketplace. The question to Dalio: maybe the vitality of the economy will drive us forward and we don't need the help from those folks in Washington at the central bank? Question mark. Dalio: we hope we don't, but we live in this world that we're affected by, and also we're pretty sure that one day we're going to need it. There's always downturns, there's upturns, and there's downturns. That's the business cycle, the short-term debt cycle. We see that all the time. Now, again, I don't know why any of this is really relevant. It's fun copy to read, I guess. You read it, and then you go home and you get what? Nervous, fearful, you do nothing. He's running a 100% systematic fund. The views aren't relevant to you or him. He already knows what he wants to do. He's written it down in spreadsheets. He's going to follow those rules religiously, without question. Continuing, another question to him. But you also see superimposed over the short-term gyrations, these cycles, a big set of long ones. Dalio responds, yeah, people don't know much about the long-term debt cycle because they only come around once in one's lifetime, but they've existed throughout history. You can go back to the Old Testament and they talk about the year of Jubilee, the relief of that debt. The short-term debt cycles add up to a long-term debt cycle because we prefer stimulation over restraint, and so debts rise relative to incomes for a long time. And because we want to perpetuate that, central banks do, they lower interest rates until they hit zero. And when they hit zero and there's high debt relative to GDP, they are in a bind. And last time that happened was 1930. In other words, we had the stock market crash, then they lowered interest rates, and so on. What does the historical narrative do for you today in 2016? It does absolutely nothing for you. And as smart and as rich as Ray Dalio is, trying to go back and say that we can learn from a debt cycle that all of us only see once in our lifetime. I mean, his firm has only been running for 40 years or so, right? Less than 40 years, 30 to 40 years. That's a lot of belief. That's a lot of trust in one guy to be so right. And how does any of that translate to buying and selling? What's the connective tissue? How do those words connect to long the S&P, short the S&P, long oil, short oil? How does it connect? Now, he's not telling us how it connects. He's leaving that part of the equation out. The questions continue. And what happened in 2007, 2008 wasn't the resolution of a long-term debt cycle. You're saying that we're still working on that current one? Now, again, that question is coming in April of 2016 to Ray Dalio. Dalio responds, just like what happened in 1930 to 1932, it's not the resolution of the long-term debt cycle. It continued on because still the debts are high in relation to the income, and still you're close to a zero interest rate. So what the Federal Reserve is doing by putting more money into the economy is it's having that money allow more spending without raising debts. So that's been a good thing. So when we start to imagine the next downturn, which I don't think it's going to happen this year or next, I'm not sure when it's going to happen. End quote. Well, I mean, seriously, in one sentence, which I don't think it's going to happen this year or next, I'm not sure when it's going to happen. Why are we fucking listening? Why does it matter? Why does it matter? It doesn't matter. None of this matters. The only thing that matters is, do you have an approach that says, these are the markets you are going to trade. This is when you are going to buy. This is when you're going to sell. This is when you're going to sell with a loss. This is when you're going to sell with a gain. And this is how much of your limited capital you're going to bet on each trade. And you can bet one damn thing. Ray Dalio does that exact same damn thinking at his shop too. The stuff that I just read, that's the public consumption nonsense to keep everyone busy. Now, I'm not saying that Ray Dalio does not have an in-depth understanding of the economy. Perhaps he does. It sounds like he does. Many people respect that he does. But every economist, including all of the officials at the Fed, every last one of them got everything wrong that they could possibly get wrong about 2007 to 2008. So I want to hear Ray Dalio talk about his trading strategy. I want to hear Ray Dalio talk about what he does on the buying and selling and the betting and the portfolio selection. The opinions that are so nonspecific to say, I don't think it's going to happen this year or next year. I'm not sure when it's going to happen, and have that all be in one sentence. Oh my God, that's the definition of insanity. And I'm not saying Ray Dalio is insane. I'm just saying that when you turn on the microphone and you're talking to the press, maybe sometimes you forget. You forget and you just keep talking. I'm probably guilty of this too, but I try to always bring it back to the basics, to the only truth that we have. And the only truth that we have is the price. Everything else, it ain't true, or it ain't provable, or it's just an opinion. And how the hell does that help you? Just the person out there. Just the person out there that perhaps is running your own money, running a small fund, a large fund. None of these views about what the Fed may or may not do. And of course, I don't like the idea in any way, shape, or form that the Fed has stolen interest income from millions upon millions of people. They have stolen that interest income to trick the stock market to go higher. So as much as Ray Dalio wants to talk about how it could be very negative if the Fed raises rates, well, it's only negative for people that are purely long the stock market and can't afford to have the stock market go down. If somebody has money in the bank and they want interest income, raising rates is not a bad thing. You got winners, you got losers. What really sucks is when the government is in control of picking those winners and losers. That really sucks. That's not the definition of capitalism by any stretch of the imagination, and it surely isn't fair. And it is one of the reasons when we all start to think about crony capitalism, politicians being paid off, the whole system stinks. Let me get off my tangent for a moment and get back to this article. Question, but what are they going to do if it goes down, especially if the quantitative easing strategy is getting long in the tooth and is less effective? Dalio responds, if they raise interest rates too quickly, you will see that affected in stock and bond prices. Then that not only affects psychology, it affects wealth and it adversely affects spending. And so it's a delicate thing there, so they'll have to tread lightly. Ladies and gentlemen, I challenge you to go out right now and pull out an Excel spreadsheet and try to quantify the words delicate, tread, lightly, thing. What does any of this mean in terms of numbers? Again, and I'm going to beat this dead horse, Ray Dalio, and I respect this, is a systematic guy. He doesn't sit around like some day trader in some kind of mental masturbation case all day long. No. This man is very, very wise, very smart. He runs that systematic strategy. My beef today is the words. For a guy that can get instant press at any given point in time, his words don't connect to the reality of his trading. I would challenge that Ray Dalio can help, if that's his goal, if he wants to help as many investors and traders as possible. He would be much better off to not talk about these debt cycles, short or long term, in such generic terms that it can mean anything. Not to use words like delicate, which can mean anything. I'm looking at flowers right now, delicate flowers, a delicate woman. What the hell does delicate mean? Put this stuff into real terms where real investors and real traders can use your very, very smart wisdom in a positive way for their own accounts. Don't present Oz behind the curtain generalities that no one can really interpret in any kind of definite way. The Oz behind the curtain stuff doesn't help. It just doesn't help. What would help is if you said, hey, I'm Ray Dalio. I buy here, I sell here, I bet this much. This is my portfolio. If he did that, he would have 10 times more fans. So many more people would be going, man, that guy Ray Dalio, yeah, okay, his economic cycle video on YouTube, that's kind of cool, nice animation, nice story, helps me with an economic understanding. But hey, now Ray Dalio is telling me about his system. Now I'm excited. Now I'm learning. Now we're making progress. And you know, this is why I love trend following traders, because trend following traders always talk like this. I almost worship when I see the words from many of the trend following legends. I worship the fact that the good ones stick to their guns. They don't allow themselves off the trend following reservation. Oh yes, I know that wasn't politically correct. Shoot me. They don't allow themselves off the trend following reservation. They stick to their guns, they stick to their systems, and they talk about their systems in concrete, understandable ways. Now, of course, trend following is still outside of the mainstream. We're still the outsiders. And many people don't understand trend following trading still. No doubt about it. It's very different than what you hear in the 24/7 news cycle. But that trend following specificity that you hear from the trend following legends, where they only allow themselves to be specific, buy, sell with a win, sell with a loss. Here's my betting strategy. Here's how much of my limited capital I'm going to bet on each trade. And here's my portfolio that I'm tracking. That's keeping it real. If you want to make money, if you really want to trust yourself, because you're sure as hell the only person you can trust, trend following is the only strategy that I've seen yet that gives something real that you can believe in. And damn it, for almost 20 years, it's kept me as excited as hell to try and pass along what I've seen to everyone else. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.